and welcome to another episode of Facts and Facts. This is the segment where I break down facts and data when it comes to property investment, as well as respond to your frequently asked questions. So today's episode is based on a few questions that I've been getting over the last fortnight. And what I've done is tie a few of them in together because they do go hand in hand. And so what these questions are around is there's a lot of news out there about an impending housing crisis with all the talk of rents going up and likely to increase. So on the back of that, there's been a fair few questions on what does that mean? Why is that happening? What are the supply levels moving forward? And investors are asking, should now be a time to start looking at apartments as an investment choice, more affordable and tend to have better cash flows as well, given where environmental rates are rising. So what I'm going to do is kind of tie this all in together and respond to this. I do want to give you a heads up. There is a heavy amount of data in this episode, a lot of graphs and things. So I'll try and keep it as simple as possible and try and make it as engaging as I can for you along the way too. All right, so before I get into the supply side of things, what I want to maybe first talk about is population. So you can see the population growth, because I guess you need to look at both of them hand in hand. For the sake of this presentation today, I'm using a particular state, and that's Victoria, as an example. What I'm talking about here is happening in various degrees in every single state in Australia at the moment. I just want to use Victoria as an example. It's one of those markets I've been giving a lot of extra attention to at the moment, and a market where we're big believers in long term as well. I'll give you little snippets of why, but I'll save the detail for another time. So you can see here with population, before we got hit by COVID, Melbourne, you were getting about 87,000, 85,000 people, overseas migrants coming in to Melbourne. You can see that during COVID, there was actually people that were lost, all those things with lockdowns and whatnot that was going there. But now coming out the other side, looking at the financial year for 2023, we're going to be back on the same trajectory that we were at before. So we're looking at 65,000, 80,000, 86,000 in terms of number of people that are going to be coming into the country and specifically going into Victoria. Now, diving one level deeper, so this was a little segment provided by a group called Charter Keck Kramer. They provide a lot of data and insights for developers out there when they're kind of deciding on feasibility for their development options. And what is interesting here is looking at how overseas migrants behave when they first come into the country. And based on the data, there is a preference for higher density, so apartment living. And it's not in this segment here, but generally within that 15 kilometers within Melbourne, as in from the CBD. So that way they've got easy access and transport to jobs, as well as take advantage of all the infrastructure amenities that tends to come with. The other interesting thing to note is that they typically, on average, rent for 4 to 7 years before purchasing a dwelling. So what that's going to mean in the short term is there's going to be a lot of renters coming into that market, specifically in that inner ring, specifically in apartments, and that's going to put a lot of pressure on rents, already high rents, to keep increasing as well. So this graph here kind of ties into what I was showing a little bit earlier. It's the same numbers that I was showing before, but in a line graph form. And what this is showing here is Victoria, compared to every other state, is going to get the highest amount of overseas migration. And what that means as a net result is by about 2029 to 2030, you're going to see Victoria's population overtake New South Wales. And that's one of the big reasons this market is such an opportune market to get into. When you're looking at comparable stock from New South Wales and Victoria, when you're looking at things like proximity from CBD, you're looking at a 40% to 50% differential in pricing. I'm not saying the pricing in Victoria is going to overtake New South Wales. There's a number of other things that affect pricing, but almost certainly we're going to see the price gap start to close and start closing quite significantly. So yeah, so that's kind of what's happening with population. You can see the numbers. If you can try and remember the numbers, you're looking at roughly 80,000+ people coming into the country each year. Before I go into some of the data about future supply, what I want to talk about is current supply. And one of the best ways to look at that is to look at current vacancy rates. We are in Melbourne right now at a vacancy rate of 1.4. That's the lowest in recent history. The last time it was that low was for a brief moment back in 2006. What's different this time is this trend that you can see here from COVID times and coming down, pardon me, is that line is likely to keep continuing to go like that. So the vacancy rates are going to get lower and lower and lower, so meaning less and less stock available for people to rent. And what that ultimately is going to mean is that rental prices are going to keep increasing. What I've done here on the side, which you can just do, is just Google Melbourne and rent and just click on news. And you can just pretty much see article after article that comes up talking about rents increasing, the difficulties for people to find a rental, vacancy rates going down, and that the rents are surging but headed even higher, as you can see on one of these articles as well. So that's giving a sign of what's to come, and that's really only factoring in what's happening now. What's going to get really interesting is what I'm going to show you next, which is talking about future supply levels coming in. So what I've got here, I'll make my head smaller. Here it's showing apartment launches and apartment launches and apartment commencements year on year. And what you can clearly see is that the trend, once again, is coming down and coming down quite hard. Of course, apartments aren't the only housing supply. You've got apartments, you've got townhouses, you've got houses. But I guess what you're really looking at here is the trend of what's happening and what that's likely to mean. So we're in an environment where population is going to be increasing dramatically, and apartment commencements, which usually from launch all the way to completion, can take anywhere from 18 to 3 to 5 years. So launch means when they kind of launch, and so I'm just repeating myself there, but launch means when the project starts to sell, and developers generally need a certain amount of pre-sales before they then commence. And then once they commence, that then is normally about a 2-year process to build. So you can see the launch numbers, and at 4,100 for this financial year, we're at, once again, all-time lows. So really, because of the time lag that you're going to get from launch to completion, and with this trend likely continuing with a lot of new developers not wanting to launch in the current environment due to increased costs, due to increased labor costs, building costs, etc., it's really, from what I'm seeing, going to be 5-7 years before we see a recovery in terms of stock. And the unknown question is how fast that recovery going to be, and really based on I guess an educated guess on what's happening, it's really going to be 10 years plus before we're going to be able to catch up with the backfill that we're going to be having. So this is, I guess, the real not scary thing with housing that's happening. Population increasing, vacancy rates already low, and future commencements at all-time lows. So this then now takes what I was showing you before and forecasts the amount of stock that's going to be coming to market over the next few years. And just because the numbers are here, they're going to assume that some of these won't complete or will get delayed as well. But this is the rough forecast on what we're seeing. So we're seeing about 80 to 85,000 people coming into the country. And in terms of apartment stock, which usually makes up a significant volume, going down. And we're looking at numbers of 4,500. So, like I said, a lot of other factors that go into supply, but the trend is what is quite scary. And what that's going to mean is that this decreased shortage is going to be, I guess, put further pressure on rents to increase. And as rents are going to increase for this kind of stock, over time, you'll start to see people not wanting to rent and then buy into this stock, and that will then help with the values of this type of stock as well. So what I wanted to kind of show you here, and when I guess I'm talking a lot about apartments here because that's the question that was asked by the group. It's not that apartments is the better choice. It's a choice. But overall, what I'll be looking at though is apartments that are around that sub 750 range, as well as if I was looking at houses, then I'll be looking a little bit further out on the fringe suburbs and looking at stock that's around that 650 to 750 range. So I'll be sticking in that same kind of price point. Because that is what's affordable in the current market. And when I say affordable, I mean now with interest rates going up, there's a huge flight for people going to affordable stock. So people that want to not leave the areas that they like, which a lot of people won't, they'll then now move to apartments in those locations. And for those people that want to go have that house and land opportunity or a townhouse or something like that, they're likely going to go a little bit further away to do that and get into those opportunities. So those are probably the two types of opportunities I'll be really focusing in if you're looking at investing in Melbourne. What I wanted to highlight here in this graph is the widening gap between apartments and houses. So you can see here that this is the widest the gap has ever been. So that 52.4% gap between that median price of a Melbourne unit and a house. So what I just touched on with affordability, we're going to start seeing a big shift towards people buying this kind of stock. And that gap is going to get a lot closer. And why I feel quite strongly that in terms of timing the market, getting into good apartment stock, surrounded by infrastructure, amenity, etc., is going to be a really good opportunity. Once again, it's not just about going out there and just buying it willy-nilly. It's about looking at a lot of the other factors too, but I'm just talking about this on a macro level. What I wanted to show you here at the bottom is just to help bust a little bit of a myth, just about, I guess, apartment growth and things like that. I think sometimes in certain areas where there's been a lot of supply, the apartments haven't grown as much. But if you look at over the last 25 years, you look at the average annual price growth of a house in Melbourne, it's 8.1%, and an apartment is 6.6%. So it's not that it's definitely house and lands have had a better growth trajectory over the last 25 years, but the apartments have also grown quite well. And the reason I'm just doing that is sometimes people have a bit of a feeling that apartments don't grow. Then you hear a few more horror stories, and then because of that, people get turned away a little bit. But I'm just sharing that because, yeah, they are still a good opportunity. Just need to be a little bit more selective about which areas you're going into and making sure that you're not going into areas with oversupply, etc. Because albeit on a macro level, there's going to be a supply shortage. We want to be able to identify the areas that are going to, I guess, where that's going to be exacerbated even more. Okay, so what I wanted to do, this is a real life example that I did for a client the other day where they were comparing a house and land on the fringe suburbs of Melbourne about 30 k's out versus an apartment that was 3 k's from the CBD. I'm not going to go through this line by line. All I want to show you on a macro level is that currently a lot of people are going for apartments as an option because the cash flow tends to be a bit better. You factor in all the expenses, your things like your body corporate, which otherwise known as your strata, and all your other expenses that go into it, and then you also then factor in the amount of rent that you're getting, and of course the amount of tax depreciation that you're getting depending on the type of stock you're going for. Apartments tax depreciation is a lot better, just because the land component is a lot smaller and it's the building cost that you can depreciate. So in these graphs, forecasts here, what I've done as a capital growth rate is put 6.5 for a house and put 5% for an apartment, much lower than what I showed you before with the 8.1 and 6.5, but that's because we always just try and do things a little bit more conservative. And I do believe just timing in the market, the capital growth on apartments is going to be better in the short term, but just for argument's sake, let's put house higher and apartments at 5. And what I've done at the top here is I've done, based on the growth after 3 years, what is the amount of equity that's likely to be in that based on that compounding interest of 6.5 for a house, and similar for the apartment at 5%. So you can see this house is worth $135,000 extra. The apartment is worth about $107,000 extra based on those numbers. What I've also done, which is what people don't tend to do, is also look at the cash flow. So based on this, you're looking in 3 years, the positive cash flow for this is like this numbers here, the $2,011, 2149, and the 2321. I've just added those together. So total positive cash flow of $6,481. Having done the same for the apartment, that looks like $18,025. So as a total, you're looking at about $141,000 here for the house and $125,210 for the apartment, which is not that significant. And also remembering that cash flow that you have, that's something that you can stick in an offset account, pay you for principal faster. That's also working for you. So the net result tends to be a little bit better as well. So just to repeat what I said before, so should you be going for an apartment? I think it's a very opportune time to get into the apartment market, as I'm specifically in the area of Melbourne that I just mentioned. Definitely a lot of other markets that are worth exploring as well. But also the fringe suburb houses that are at a similar price point also provide just as a good opportunity as well. So it's just going to come down to preference and what kind of strategy you're going, what you may already have in your portfolio as well. But one of the big reasons I guess people are shifting, or there's been more of a shift towards apartments, is because of that cash flow element, and it provides a lot more comfort in an environment where rates are rising. So hope this was quite insightful. There was a lot of information to go through, but in summary, what's happening is population is growing, supply levels, so vacancy rates are already low, supply levels are getting lower and lower, so there's going to be a crisis, rents are going to go up, and there's a flight to affordability based on people's borrowing capacities. So this is the kind of stock that I would be exploring in a lot more detail. So, and all of just what I just mentioned, if you're thinking about on the fence about getting into the market and you're trying to time it, look, the reality is, look, no one exactly knows where the bottom of the market is and where we're going to start seeing the effects of all this and how far away it's going to happen. And rather than waiting and being in fear, jump in, get a good opportunity while you can, because at the moment there's not a huge shift in growth at this price point, albeit they're growing quite slowly because people still need somewhere to live. But there will be a time where that starts to shift. I'm not going to be able to say exactly when, but my advice would be, if you can afford it and it makes sense for you, then start to look at some of this stuff quite seriously, because it's only a matter of time before we start to see all of this have an effect on prices as well. All right, awesome. Hope you enjoyed this, and I'll see you in the next one.